Good morning and welcome to the Monday Morning Market Recap brought to you by Island Park Private Wealth. Before we jump in, I want to take a second to wish those that celebrate a very joyous and Merry Christmas this week. And if you're traveling to see family and friends, we hope your travels are safe and with little delay. So we'll jump into our Monday Morning Market Recap. As normal, we'll give you a little overview of the markets last week and we'll discuss some of our key takeaways. Markets ended the week in a more measured and selective mood as investors digested signs of a cooling economy. Equity markets were choppy, with weakness concentrated in the technology and AI related stocks, rather than broad market weakness. The S&P 500 fell nearly 2%, while the Nasdaq and the Russell 2000 declined closer to 3%. The growth, momentum, and high beta factors all underperformed, while the value, equal weight, and low volatility outperformed on a relative basis. Technology and energy names both traded lower by over 4%, while consumer staples, healthcare, and utilities traded higher. Bonds ended the week modestly higher as Treasury yields drifted lower, although longer maturity bonds underperformed. The VIX Market Volatility Index rose as technology stocks weighed on the broad index, and oil prices declined by nearly 3%. Our key takeaways from last week were: one, the November jobs report reinforced the view that hiring demand is gradually cooling rather than rolling over. Job growth has moderated, wage pressures continue to ease, and there remains little evidence of broad-based layoffs across the economy. While the labor market is no longer running hot, it continues to show resilience beneath the surface. The labor backdrop continues to support a soft landing narrative, giving the Federal Reserve room to remain patient and data dependent. Point two, the recent economic data continued to point towards a gradual cooling and growth rather than an abrupt downturn. Regional manufacturing surveys and business activity softened, retail sales were flat, and housing sentiment remained subdued. Meanwhile, business inventories rose and core consumer spending in categories outside autos and gasoline held up better, suggesting demand is cooling but not collapsing. The picture that emerges is one of deceleration, not contraction. While the economy is no longer running as hot as it was earlier in the cycle, current conditions remain consistent with a soft landing path rather than an imminent recession. Point three, inflation data this week reinforced the trend of cooling price pressures across the economy. The delayed November CPI report came in below expectations, wage growth slowed, and oil prices are near a 4-year low. Together, that data reinforces the narrative of disinflation plus slower growth. While inflation is not yet back to the 2% target, the direction of travel remains constructive. Inflation pressures continue to gradually cool, and while the disinflation process won't be smooth, markets see a backdrop where inflation is easing without an imminent sign of severe economic stress. Point four, the Treasury markets continue to adjust to a slower growth, lower inflation backdrop, with yields falling as investors balanced a cooling economy against a patient central bank. The market continues to price in more rate cuts than the Fed, despite this week's jobs and inflation data, justifying the Fed's patient approach. Now, the market and the Fed won't fully agree on the pace and timing of future cuts, but the gap is relatively small. Point five, major U.S. equity indexes finished the week modestly lower, with the S&P 500 and the Nasdaq showing significant volatility. Weakness was concentrated in the mega cap technology, growth, and AI exposed names, which heavily impacted headline index performance due to the concentration. But in contrast, the average stock was more resilient, with equal weighted indexes outperforming their cap weighted counterparts. This week's index declines were driven by a narrow group of large cap stocks rather than broad-based weakness. And the last point is that AI-related stocks remain under pressure, with chip makers, cloud providers, and data center-linked companies underperforming. The question is whether the pullback represents a healthy reset following strong gains or signs of a greater caution around capital spending and near-term profitability. The sell-off highlights risks of a concentration in a narrow set of high expectation stocks, It does not negate the long-term potential of AI, but it underscores how quickly sentiment and valuations can adjust around crowded themes. And that's our Monday morning market recap from Island Park Private Wealth. We hope you enjoy it. If you do, please subscribe to our channel. And we're here every Monday morning. Thank you. And we'll talk to you next week.